stock options. And specifically, we're going to talk about non-qualified stock options in this example. You're going to have GAAP to tax differences. And let's see why. I want to show you a year 1 when the stock option was issued, and I want to show you year 3 when the stock option was exercised, so you can see the difference between the accounting from a GAAP to tax standpoint. So from a GAAP standpoint for stock options, we're gonna look to ASC 718-10-35-2. And stock option expense can be fairly complicated. A lot of times you're gonna have software that does the calculation for you. But basically, you want to find what the fair market value of that option is when it's been issued, and you want to take the that fair market value times the number of options that have been granted, and you're going to straight line amortize the stock options over typically your vesting period. So in this example, we have a 3-year vesting period. Our fair market value of the options that were issued is going to be $15 times 10,000 shares. We have $150,000 of options that have been granted that we need to amortize over the vesting period of time. And with the vesting period of time being 3 years, it's going to be $50,000 a year of expense. So I'm going to take the $150,000 value, divide it by 3. I have my stock option expense from a GAAP standpoint of $50,000. Now, from a tax standpoint, year 1, literally going to do nothing. Just because the stock option has been granted, from a tax standpoint, that does nothing. The person receiving them doesn't have a taxable event. The company granting them, it doesn't have a taxable event either. There's no tax consequence until the person who received the stock option actually exercises. All right, let's jump down to year 3 because we're going to have a little bit different of a scenario based upon the person who has received these stock options exercising those options. So we still have the $15 fair market value of the option that was determined when the business granted those options, but the stock price has gone up to $45, and we have a strike price of $25. So there's a $20 spread. So there is a gain or a built-in gain on these options right now. And we're assuming the person that received these stock options has exercised all 10,000 of those options. So let's see what happens from a GAAP and tax standpoint in year 3 based upon somebody exercising these 10,000 stock options in this scenario. So from a GAAP standpoint, we're par for the course. We're just going to take our $50,000 of amortization that we talked about. We have our value of the options when they're issued, and we're recognizing that expense over the vesting period. Now, from a tax standpoint, we have a taxable event. That person has exercised their options, and from a tax standpoint, you can deduct the stock price less the strike price. In this instance, is $20 times 10,000 options. You can deduct that because that is going to be stock option expense from a tax standpoint. And on the flip side, the person that's exercising those options is going to be taxed on that as well. So in this scenario, from a tax standpoint, we're going to take our stock price of $45, our strike price of $25, and we're going to multiply the difference, the delta between the stock and the strike price, times 10,000 options. That's the taxable income to the person exercising. This is the stock option expense from a tax standpoint for the business. So you can see there's a large difference on a stock when somebody exercises their options from a tax and GAAP standpoint. If you look at the net income on a GAAP basis, year 3, $250,000. On a tax basis, my net income is $100,000. There is a big difference based upon the methodology of how you recognize stock options and stock option expense.